Hello, welcome everybody to the first session on financial markets in India and monetary policy. Now, before we start with the session, let us look at the story of or a situation of a fresh graduate who is also preparing for bank exam or maybe some other competitive exam, and let's say his name is Bishal. Now, on a certain day, Bishal lost his purse and he had to refill or recharge his mobile phone, and for that he needed some rupees 249 rupees. Now what Bishal can do, he can actually go to his friend and ask for 249 rupees and make a promise that he is going to return it on the next day. So this is one situation. Now look at the second situation. Now suppose on certain day, some other day, the screen of the mobile phone is broken. So we shall need to repair it. But the cost here is something around rupees 3000, and his pocket money is only 5000 rupees. So this month or right now he cannot repair it. So what he does, he goes to a friend who is a cash rich friend. You know, in every group there are some people who are having higher amount of cash, and he goes to him, that friend, and asks for rupees 3000 rupees and makes a promise that, see, next month when I'll get my pocket money, I'm going to repay it. So look at the two situations. In the first case, he had a liquidity shortfall, very small amount of shortfall, and by the next day he can overcome that shortfall and he can also repay it. Where in the second case, that is also a liquidity shortfall, whereas that liquidity shortfall is slightly larger in amount, and he makes a promise which is a time bound promise. He says that I'm going to repay it on, say, 2nd of next month or 3rd of next month, maybe after 15 days or 20 days or 30 days, right? And now let's look at another situation. Vishal thinks of buying a bike. Now obviously, if the bike is costing rupees, say, 1.1 lakh, he cannot go to a friend and ask for 1.1 lakh. You can understand. So what he does, he goes to a bank and takes a loan, and he comes into an agreement with the bank that this amount will be paid in terms of equal monthly installments, which is known as equated monthly installment, EMI. Every month he will pay some installment. Now this situation is slightly different than the first two. In the first two, he had a liquidity shortfall, short term. In this case, he is making an asset or to upgrade his, style of life. He has moved to that option, and there the repayment procedure is different than these two cases. Trust me, banking and economics are quite similar to our daily life. Exactly similar situations banks are also facing. And this is where this money market and monetary policy comes into picture. So it is not something entirely different, rocket science, very easy. You can easily relate with your daily life, and you can easily remember it and perform well in the exam. So as long as it is about core banking, monetary policy, or maybe money market, banking instruments and products, trust me, try to understand the concept behind it, and I'm sure that you'll be able to answer the questions easily. So with that, welcome once again. We're going to start our first session on monetary market, monetary policy and money market. So what is financial market in India comprising of? So the financial market in India is majorly comprises of three things, three types of market: money market, government security market, capital market, which is regulated by SEBI. The first two are regulated by RBI, capital market or share market. However, there's a fourth category also exists, which is called foreign exchange market, which comes under the regulatory ambit of RBI itself. So from RBI's perspective, RBI is regulator of three markets: money market, government security market and foreign exchange market. Whereas it comes to capital market, it is regulated by SEBI. SEBI stands for Securities Exchange Board of India. Securities Exchange Board of India, SEBI. Let us look at this diagram. This picture clearly gives you the idea what I am talking about. When you go to RBI website, it's a screenshot of RBI website. On the left side, this blue tab will appear, market trends, and when you click on that, it gives you money market, it gives you government security market, and this is capital market, like we have Sensex, Nifty, share market indexes. These products we are going to discuss in detail in this class and the next class. Now in the next 40-50 minutes we will be focusing on money market, and if you see, this exchange rate is shown over here, which is nothing but related with this foreign exchange market. Okay, I hope it is clear. Let's move to the first type of market, money market. Now, what is a money market? Let's take again an example. What is a vegetable market? So I've come across people come up with the answer that vegetable market is where vegetables are available. Vegetables are also available in field where they are cultivated, but that is not a vegetable market. Vegetables are also available in cold storage, but that is not vegetable market. Vegetable market are that where vegetables are traded. That means vegetables are brought as well as vegetables are sold. In other words, vegetable is treated as the commodity. Similarly, in money market, money is treated as the commodity. Now if you look at, I have mentioned here organized. Now when I say organized, there are actually in most of the countries there are organized money market as well as unorganized money market. Now what is an unorganized money market? We have heard of individual money lenders, particularly in wholesale big markets. You will find individual money lenders, mahajans in rural areas who lend money at very high rate of interest and they are not regulated. These are unorganized money market. Here our discussion is limited to organized money market. Now, organized money market is a financial market where securities or short-term maturities, 1 year or less, are bought and sold. Now, let's come back. I just said that where money is the commodity, so money is traded. But then what is the securities of short-term maturity? What is this? Are bought and sold. So these securities are nothing but the instrument, you can say it's a vehicle with which the money is brought or sold. So in exchange, these securities are given. Suppose I move to a bank or somewhere else and I would like to take some money. So in return, I have to give a piece of paper, a security, against which I'll get the money. So here this second important term is 1 year or less. So short-term market is where the short-term maturities, all the money market instruments what we will be discussing, all of them are of maturity period 1 year or less. The major function is to meet short-term financial needs of public and corporate, and obviously in certain extent government also. So if you recall the case of Vishal, he had short-term financial needs and he had long-term financial needs also. So the short-term financial needs like he had. Similarly, if sudden short-term financial need appears for an individual or a corporate or maybe for the government also, they can come to money market and look for those type of fund. Now, some of the features of money market. High liquidity. Why high liquidity? Because the instruments or the assets which are traded in money market are having maturity period of 1 year or less. In certain cases, they can be also convert it into liquid cash even before the maturity period. So please understand, when I say high liquidity, that means something which can be easily converted into cash, we'll say it's a high liquidity. For example, let's say gold. If I have certain amount of gold, within maybe day 1 or day 2, I can convert it into liquid cash by taking a gold loan, or I can sell it also. On the contrary, if I have a big house or a land, selling the land is not quite that fast process. It takes time. So it is not that easy process. So it may appreciate, but the liquidity of land is less. So money market is high liquidity. Secure investment. Yes, most of the instruments and the tradings in organized money market are secured in nature. You will understand in later slides why it is secured in nature. Fixed return. It is not like share market or capital market where the return is unknown. It can be 10%, 20%, or it can be even loss as well. So you can easily understand where the risk is less, return is also less. So fixed return, risk is less, secured investment, whereas in capital market risk is more, share market risk is more, return may be also more. Physical trading or OTC, over the counter. When I say physical trading, that means it is done manually. A piece of paper, physical piece of paper is the instrument which has to be exchanged. No digital transaction takes place in case of most of the operations in money market. So it does not exist in digital form. The instrument does not exist in digital form. Obviously, a digital entry is possible, but the exchange is not in digital form, like what happens in case of share market, where we say demat account, a share trading. If I have to buy some share, I buy from demat account. Demat account stands for dematerialized account. Dematerialized account, why it is called dematerialized account? Because it is not in material form, it exists in digital form. So these shares, mutual funds, they exist into digital form. Here it is not the case. Most of the instruments are in physical form, and money market is regulated by RBI. So let's sum up once again important points. Money market, two types: organized, unorganized. Individual lenders, mahajans, they come under the category of unorganized money market. One of the important feature of money market instruments that they are of short term maturity, 1 year or less than 1 year, secure investment, fixed returns, and regulated by RBI. Alright. Who can participate in money market? Now, central government, state government, primary dealers, mutual funds, large corporate with good credit rating, banks, PSUs, insurance companies, NBFCs, and Discount and Finance Corporation of India. Now, among this, all these options, like you already know what is central government saying. Now, let me spend little time on primary market, primary dealers. These primary dealers are like wholesalers. So they buy it from RBI and sell government securities to the banks or in the secondary market. We'll discuss a detail of primary dealers in some of the later slides, but as of now, just simply understand a primary dealer is you can say it's a wholesaler. So what does they do? They buy government securities in bulk and then they bring it in the secondary market to sell it to the other banks or NBFCs. Large corporates with good rating, credit rating. Yes. What is credit rating? Credit rating are credit worthiness of those corporates. Now who gives it? There are credit rating agencies. There are credit rating agencies like CRISIL, ICRA, CARE. CRISIL, ICRA, IICRA, ICRA, and CARE, CARE, CARE. So these are three primary credit rating agencies of India, and they give or provide this credit rating to the large corporates, banks, PSUs. Discount and Finance Corporation of India is actually an entity formed by Government of India and RBI to mobilize this government securities into the money market. So with that particular purpose of playing a pivotal role, playing a significant role, a middleman between government and the financial organizations, will be the middleman to buy government securities or maybe mutual funds from one organization to another organization and sell it to somebody else. So if you look at presently, this DFHI, Discount and Finance Corporation of India, has been taken over by State Bank of India, so it is known as SBI DFHI Limited. If you visit the website, in the About Us, see what it shows. It is into products and services. It is into government securities, state development loans, SDL. These are nothing but securities issued by state governments. Short-term securities issued by state government. It's called SDL. Treasury bills, money market instrument. We'll see what are these money market instruments. Corporate bonds, we'll discuss in detail, and mutual fund products. So SBI DFHI Limited, Discount and Finance Corporation of India Limited, is now been taken over by SBI. So these are the players who can participate in money market. What are the types of money market, or what are the different instruments of money market? Now, if you see, the first one is bill market. Now, in some of the sources, bill market is treated as money market. Again, in some cases, bill market is treated as a security market. But here, if bill market, if I am saying under money market, I am precisely talking about treasury bills. Let me repeat it once again. Please understand, government securities are of two types: short term, long term. Less than 1 year is called short term. More than 1 year maturity period is called long term. Now both are part of security market, whereas treasury bills, which is a short term government security, is also traded in money market. Treasury bills, which is a part of government security market, is also traded in money market. Let me make it simpler by giving an example. Suppose I brought some shares from a company, let's say TCS, 3 years back, and now I am selling these shares of TCS to somebody else, maybe XYZ, through some trading agency, right? So that product, when I brought it initially, that was in primary market, but later I am trading in the secondary market. So that can be done with treasury bills. So that's why when I say bill market, here I am talking about treasury bills and short-term government securities. Even state development loan, SDL, will also come under this category. Call money market. Okay. Now recall that case of Bishal. What happened when Bishal lost his purse? He had to recharge his mobile phone, and for that he had to borrow from somebody so that he could give it back on the next day. So kind of promise was for 1 day, overnight borrowing, and it was a very short amount of liquidity shortfall. Banks also, when they run their operations day by day, they fall short of liquidity. Quite obvious. Suppose on a certain day the withdrawal from the bank is more, or bank has to pay or bank has to forward some huge amount of loan. As a result, their liquidity, whatever is the, that level of liquidity they usually maintain, it fell below that. But it knows that tomorrow it can get the fund from somewhere else. But to start the bank, he has to reach that particular level. So what he does? He goes to his friend. Who is a friend of a bank? Another bank. So what he does? He goes to that bank and borrows a certain amount of money for one day, overnight borrowing, right? So this type of market is called call money market. This type of market is called call money market. We'll come back to this call money market, something a little bit more also. Now, when money is borrowed in call money market, is it at free of cost? Absolutely not. Banks are professional. Now, in this case, one bank charges interest from other bank. The rate of interest charged is called call rate. Now, let me come once again. So, who is borrowing? A bank is borrowing. From whom? From another bank. The rate of interest applicable is called call rate. Now, apart from banks, insurance companies can also participate in call money market. However, please understand, our next question comes, is there any security or a mortgage needed in case of call money borrowing? Generally, we know whenever we take a loan from bank takes something as a security, a mortgage or collateral or something. Now, whether anything a bank has to give it to other bank while borrowing as a security. Answer is both cases exist. Without collateral also possible, with collateral also possible. Without collateral, only banks can borrow from another bank. Let me repeat once again. Without collateral, one bank can borrow from another bank, and in this operation, insurance companies cannot participate. Whereas the other case, where borrowing can be done with collateral, so there is a term involved with that. We'll come to that. Next one. Let's come to the third case, notice money or term money market. Sometimes they are called, comes under the same market. Just for the sake of better understanding, I have put it in two different categories, call money market, notice or term money market. Now if you look at the case of Vishal, when his screen broke and he had to borrow 3,000 rupees, what type of promise he made? Did he say he is going to pay on the next day? Not at all. He said, I'm going to pay after 15 days or maybe on the second of the next month. So he mentioned a time frame, but short time. So this is where it comes notice money and term money. So notice money is up to 14 days, 2 days to 14 days. This is where we call, say, if the money is borrowed for 2 days to 14 days, we call it notice money. And if the money is borrowed from 14 days to 1 year, then we call it term money, time or term money. And in this case, the rate of interest is applicable is called MIBOR, M-I-B-O-R, Mumbai Interbank Offer Rate, Mumbai Interbank Offer Rate, Mumbai Interbank Offer Rate. Okay, check it down, MIBOR, Mumbai Interbank Offer Rate. So let me summarize once again. A bank borrowing from another bank for overnight borrowing, call money market, applicable rate of interest called call rate. It is possible with collateral, without collateral. With collateral, it's called CBLO, Collateralized Borrowing and Lending Facility. CBLO, Collateralized Borrowing and Lending Facility. For notice and term money, when it goes to term money, the rate of interest applicable is called MIBOR. Notice money generally comes under call rate only. There is no separate rate for notice money market, but for term money market, the rate of interest is MIBOR. Now, MIBOR is regulated by NSE, National Stock Exchange. MIBOR is regulated by NSE, National Stock Exchange. Let us come to the fourth category, commercial bill market. So what is this commercial bill market? Commercial bill, under commercial bill, you have certificate of deposits as well as commercial papers. Certificates of deposits are issued by banks. Commercial papers are issued by corporates, big corporates with good credit rating. As per RBI guideline, to issue a commercial paper, a corporate must have credit rating. Now, what is this commercial paper? These are debt instruments. That means using these commercial papers, big corporates can take fund from the market, and usually the tenure of this commercial market papers is from 7 to 270 days. So they are unsecured. They are not secured because they are not issued by bank. However, the risk is less because most of these big corporates are having good credit rating and they are having good business model, or they are having good reputation also. Whereas certificate of deposits are secured instruments because they are issued by banks. So this is a difference between these two, commercial paper and certificate of deposit. Both comes under commercial bill market. Bankers acceptance. Bankers acceptance is another type of money market. This is mostly related to export, import, where banks issue a note which is known as bankers acceptance. Now, if you look at, these are also instruments of money market. These are the markets and these are the instruments. Now, if you look at these are the instruments: T-bills, CP, commercial papers, certificate of deposits, CBLO, derivatives and others. Let's move to the next slide. These are some of the terminologies related to money market. CCIL, Clearing Corporation of India Limited. FIMMDA, Fixed Income Money Market and Derivatives Association of India, and FEDAI, Foreign Exchange Dealers Association of India. These are the two bodies set up by RBI, and these are association of all the money market players, and they are just, you can say it's a association, and they are the observatory body, and they make sure that the operation goes on smoothly. CCIL, whereas, is responsible to look after the entire money market operations, entire money market transactions. So all this bulk clearings takes place in money market. These are regulated by CCIL, Clearing Corporation of India Limited. These are different types of derivatives: IRD, interest rate derivatives, interest rate swap, and forward rate agreement. These are different types of derivatives. We'll discuss derivatives slightly in detail in some later classes. FEMA, Foreign Exchange Management Act 1999. FEMA Act empowers RBI to become the custodian of foreign exchange in India. Remember, this question may be asked in the exam, that which act empowers RBI to become the custodian of foreign exchange? Answer is FEMA, Foreign Exchange Management Act 1999. Okay. Let's look at some of the sample questions. Which of the following organizations provide guaranteed clearing and settlement functions for transactions in money, GSEC, that is government security, foreign exchange and derivatives market? which of the following organizations provide guaranteed clearing and settlement functions for transactions in money, government security, foreign exchange and derivatives? Now, any guess? Obviously, it's not FIMMDA, this is the association. NPCIL stands for National Payment Corporation of India Limited. NPCIL stands for National Payment Corporation of India Limited. Very important body. They are the regulator of the retail payments made in India. They are responsible for all the retail payments made in India. The CEO of Dilip Asbe, headquarter is Mumbai. When I say retail payments we generally make like IBPS, UPI, Bhim, Bharat Bill Pay, Aadhaar enabled payment system, RuPay card. This type of instruments or systems or maybe platforms are all offered by NPCIL. If you go to this NPCIL website, this is how it will look like. NPCIL website. Just click on this tab, what we do, and in the drop down menu all these services will be available. Click on each and go through overview of all these products. These are very important for the exams perspective. So please make sure visit the website and go through the overview of the product. You don't need to get into the entire detail of the thing, but make sure go through the overview of this product. So answer for this question is CCIL. NDS-OM, Negotiated Dealing System and Order Matching. NDS-OM stands for Negotiated Dealing System and Order Matching, is the online platform through which RBI sell or buy its government securities. It is the online platform through which RBI sell or buy government securities. SBI, DFHI we have already discussed. Question number 2. Which of the following is true about call rate? It is regulated by RBI, it is regulated by NSE, it is regulated by SEBI, it is fixed and not regulated. Now, if you remember the third slide of this particular presentation, when it was in the beginning of money market, it was written call rate, and just below it there was a star and something was written. I would say that you must check it. I'll not say what was written, but you must check it. Now let's see what is the answer. It is not regulated by RBI. I'll say why it is not regulated by RBI. Remember the case of Bishal. Bishal took money from his friend. He was borrowing 249 rupees from his friend. And based on their relationship and based on the kind of environment they are into, they can have their own agreement that how much interest Vishal should pay to him. Similarly, in call money market also, the interest rate is not regulated by anybody. It is completely dependent on the demand and supply situation. What I mean is, suppose there are more number of banks, there are 10 banks who are having excess liquidity, whereas only 2 banks are there who are in shortage of liquidity. So demand is more, demand is less, supply is more. Now in this case what happens? Certainly the call rate will be less. But if it is the other way around, 10 banks are in shortage of currency or liquidity, whereas there are only 3-4 banks are having excess liquidity, then the call rate is likely to be more. However, banks are not bound to borrow from call money market. There are other alternatives also. We'll see to that. So remember, call rate is not regulated by anybody. It depends on demand and supply situation, and it may vary on day to day. Every day the call rate may change. MIBOR is regulated by NSE, National Stock Exchange. SEBI does not get into money market. It is not fixed, it is not regulated. as on previous day. Call rate, always there will be as on previous day, because it may change on every day basis. So answer for this question is none of this. None of this is the answer. Which among the following is correct regarding money market? Of A, money market is a market of short-term funds. Maturity in this market ranging from overnight to 1 year. The basic functions of money market is to provide efficient liquidity position for commercial banks, financial institutions, mutual funds, insurance companies, corporates, etc. Maturity in this market is above 1 year. I'm sure by now you have understood that D is definitely not correct. Right from the beginning we are saying money market is for up to 1 year. Here 1, A, B, C, all three are correct. So the correct option should be option number 2, A, B and C. Which of the following is not applicable in case of external commercial borrowing by an Indian entity? Now, what is this external commercial borrowing? It's like an Indian entity, maybe a big corporate or a bank, borrows from some other country, some other bank which is not in India, borrows from abroad and for commercial purpose. And this can be performed only after getting some nod from RBI. Time to time RBI regulates it and RBI gives permission whether an entity can go on borrowing from external source or not. So external commercial borrowing by an entity, then if they are borrowing it, certainly some rate of interest will come. So which one is correct? Is not applicable. Look at the question, is not applicable. So from the option we can clearly say it is MIBOR, it is not applicable, because MIBOR is within India, an Indian entity borrowing from another Indian entity, then Mumbai Interbank Offer Rate will be applicable. LIBOR stands for London Interbank Offer Rate, Euribor Euro Interbank Offer Rate, TIBOR Tokyo Interbank Offer Rate. Here LIBOR, rest all are same, Euribor Euro, TIBOR Tokyo Interbank Offer Rate. Obviously all are applicable, that is not correct. So answer is option number 3. Question number 5. Commercial papers, one of the instruments of money market, can be issued by. No. Banks issue certificates of deposits. Banks and NBFCs, no. Any corporate is not correct. Answer is corporate with good credit rating. As per RBI guideline, only corporates with good credit rating can issue commercial papers. CD is issued by bank. Okay, now let's look at government security market. Now this is where the RBI on behalf of both state government and central government sell government securities. Now broadly there are two types of government securities. One is long term, which we call GSEC, or government securities of maturity period more than 1 year. It may range up to 10 years and sometimes it can be also very long term as well. Short term, less than 1 year, where we have treasury bills or T-bill. We discussed about this particular term earlier. T-bills 91 days, T-bills 182 days and T-bills 364 days. These are the maturity period. So if you see in all these cases the maturity period is less than 1 year. NDS OM, negotiated dealing system order matching, is the platform in which RBI sell or buy government securities. Now this is very significant. Try to understand. The government securities are quite significant in the economics. through this, government actually resolved two of its main purpose. One, government takes care of its fund requirement. That means government raises fund short term as well as long term from the system so that it can use that fund for developmental activities. Secondly, when it comes with the additional return yield, government is also able to introduce new additional currency into the system using government security. So these are the two main purpose of government securities. Apart from these two, that is government GSEC and treasury bills, there is another component which is called cash management bill, CMB. We'll come across this very soon in one of our later slides. As long as government securities are concerned, we have primary market and secondary market. Primary market is like, you can say it's a wholesale market. It's because RBI does not sell government securities in any amount, any random amount. RBI sells it into multiples of certain fixed amount. For example, RBI decides that I'll sell government securities of 50 crores and its multiples. That means 50 crores, 100 crores, 150 crores, like that. Not every bank or cooperative bank or regional rural banks may be ready to buy in one go 100 crores of government securities. So then there are these primary dealers. These primary dealers are, you can say, it's a vehicle for the entire market. So they buy government securities from the primary market, that means from RBI, and then further trades it in secondary market. There are a number of primary dealers in India. SBI, DFHI we have already discussed earlier. PNG Guild Limited, ICICI Securities Primary Dealership Limited. Similarly, Punjab National Bank has also got a body which is into the primary market. So like that, the primary dealers, PDs, buy government securities from primary market and further trades it into secondary market. Let's look at these questions. Which of the following securities are issued by state government in India? As I said, CMB, cash management bill. These are very short term government securities issued by RBI. Maturity period is something like 15 days or 30 days. What is the purpose? The purpose is to suck in a slight shock, or maybe all of a sudden there is an excess of liquidity in the system, then government can bring in this type of bills. It is not sold on regular basis, time to time, based on the requirement. RBI, based on like situation, RBI time to time brings on the cash management bill. SDL stands for State Developmental Loans. These are the securities issued by state government in India. eKuber is the core banking solution. Is the name of the software of core banking solution of RBI. Sovereign gold bonds are similar to government securities, but these are issued against gold reserve. These are issued against gold reserve, and individual can also buy this, but there is a certain limit. Sovereign gold bond. We have already discussed. SDL stands for State Development Loan and CMB stands for Cash Management Bill. Capital market or share market regulated by SEBI in India. There are a number of share markets in India, but let me look at the pan-India based share markets. These are the four main pan-India based share market: BSE, Bombay Stock Exchange; NSE, National Stock Exchange; Universal Stock Exchange of India; Over-the-Counter Exchange of India. There will be a later session where we will be discussing more details about share market or capital market. So for the time being, I'll restrict my discussion on share market up to this much. Now, how is money market related to monetary policy? You will see very soon that what is the main objective of monetary policy. As of now, we discussed money market, and what we have seen in money market, it is mostly related. The main purpose of money market is to take care of the short-term fund requirement of public, corporate as well as government. Now, monetary policy also has similar type of objective. So money market is kind of a vehicle, is kind of a platform which helps RBI to implement its monetary policy effectively. It helps to maintain demand and supply equilibrium with regard to short-term funds, we have already discussed, meets the need of short-term fund requirement of the government, and it helps to maintain liquidity in the economy. So quite important, money market is very much related with the monetary policy. So any changes in the monetary policy, immediate effect is reflected in the money market. Okay, so let's start with what is this monetary policy. As we know that monetary policy is prepared by RBI, and every 2 months the Monetary Policy Committee, MPC, they sit together and decide on further changes or modifications in the monetary policy. Under the control of central bank to regulate magnitudes such as interest rate, money supply, availability of credit, with a view to achieving the ultimate objective of economic policy. Now, please remember, the ultimate objective of monetary policy is economic policy and economic growth. But to do that, there are some sub-components like interest rate, inflation, money supply, availability of credit. This all will come into the entire discussion part. Who makes the monetary policy? Yes, RBI, as per the Reserve Bank of India Act 1934. But what part of RBI? Because RBI has number of verticals. So there is one particular committee called Monetary Policy Committee, MPC, Section 45ZB of RBI Act 1934. This is formed in 2016. Earlier, this used to be made by Board of Directors, the Central Board of RBI. Now there is a separate board, a committee for monetary policy. It's called MPC, Section 45ZB of RBI Act 1934, which is formed in 2016. The goals of monetary policy. Now, if you look at the website of RBI, and if you look at what is the main objective of monetary policy, this actually, the language, the literature changes time to time. However, the core idea remains the same. If I put it in different words, I would say maintain price stability. Maintain price stability means value and volume of currency in the system. Let me elaborate a little bit more. So when I say value and volume of currency, I'm talking about value of currency, whether the purchasing capacity of currency has gone up or gone down. If the purchasing capacity of the currency is gone down, that means the market is an inflation situation. That means you can purchase less using a certain amount of currency. Let's say using 100 rupees, you can purchase less what you could purchase earlier. Volume of currency is the amount of currency in the system in terms of different denominations. How much rupee should be in terms of 2000 rupee notes? How much rupee should be in terms of 500 rupees notes? What is the proportion? This is very quite important. If you have only currency notes of higher denominations, so what will happen? It will lead to an inflation. If you have only 500 rupee note, so it will be a problem of giving change when you make some purchases. Again, if you have only small denominations, that is also not suitable for transactions. If you have to make high amount of payment, so making small denominations, making a payment using small denominations would be difficult. So there has to be a balance between this. So when I say value and volume of currency, this is what RBI is looking after. Inflation target, quite related this two. In fact, if you look at present, the primary objective is talked about inflation target, and obviously when I talk this to in long term and in its overall picture, the main objective of monetary policy is economic growth. We have also come across another term called fiscal policy. Now, how these two are different, monetary policy and fiscal policy? The first difference, monetary policy is prepared by RBI, whereas fiscal policy is prepared by Government of India. Monetary policy mostly looks after the short-term parameters, short-term changes, short-term control, whereas fiscal policy is responsible for long-term control. Now, what are the main components under fiscal policy? Fiscal policy looks after inflation, unemployment, economic growth. Fiscal policy looked after inflation, unemployment, price balance or balance in the demand and supply, and unemployment, and hence economic growth. And when Government of India implements its fiscal policy, what are the different tools of that fiscal policy? Please understand, this is a very significant area. You will understand how these two are different. Government of India mainly implements this fiscal policy by making changes in tax rate, by increasing a tax or decreasing a tax, by introducing a new tax or abolishing existing tax. What happens if tax rate is increased? Suppose income tax is increased. So then public will have lesser amount of money available for spending. So less money means less amount to spend. Less amount to spend means less demand, and less demand can get into an effect of decrease in the price of the commodities. So in that way inflation can be controlled. On the contrary, if less amount is spent, less demand is created, that means the supply or production will be also less, which can hamper in the economic growth. Remember, GDP, gross domestic product, so it is directly related with the total financial value of final goods and services produced. So if you have less demand, final goods and services produced in the economy will be less, so economy may get slowed down. So it's an irony, please understand, it's a very crucially set pivot. In one side, when tax is increased, inflation can be controlled, but the GDP growth rate will become slow. Tax is reduced, so GDP growth rate may go up, but on the same side inflation can also go up. So there has to be a balance between these two, and again monetary policy is responsible for taking care of this type of short-term impact on inflation. So wherein in case of fiscal policy, the main vehicle of or the main instruments of regulating the fiscal policy are tax policies and maybe government spendings, how government is going to spend in case of giving salary to the employees or maybe some social developmental schemes. On the other side, RBI monetary policy, the instruments are various policy rates, repo rate, marginal standing facility, then bank rate, SLR, CRR. So the instruments are different, but the objectives are almost same. One is a short term and the other is a long term. So let me summarize once again. If it comes to fiscal policy, it is the responsibility of Government of India. How government looks care of this fiscal policy? By bringing some changes in taxation, by bringing some changes in spending structure, in what area government is spending and how much it's spending. Based on that, fiscal policy is decided. On the other side, monetary policy is prepared by RBI, and this is mostly for short-term control of inflation and economic growth, and the instruments are different than fiscal policy. These are repo rate, reverse repo rate, so that it can have an impact on the credit availability in the system. So we'll discuss more details about monetary policy in the following slides. Fiscal policy will be discussed in more detail in some session on economics. What are the physical instruments of monetary policy? The physical instruments of monetary, or you can say quantitative instruments of monetary policy. Policy rates. Under policy rates we have repo rate, reverse repo rate, marginal standing facility, bank rate. Yes, we have one more thing called term repo, which again comes under repo rate only. So please note, these four are considered as policy rates: repo rate, reverse repo rate, marginal standing facility, and bank rate. Reserve ratios. Reserve ratio stands for SLR, CRR. These are the two reserve ratios. We'll discuss in detail. Open market operation and market stabilizing scheme. These are quantitative instruments of monetary policy. Let us look at this particular website of RBI. When you click on this functional site, this is on the right side of RBI website, you will see there's a tab called monetary policy. If you click on that, there's an overview and then monetary policy statement. You can go through this. It actually gives a little bit more detail about what I'm talking in this slide. This is what I'm talking about, different policy rates. Under policy rates we have policy repo rate. This is exactly the slide or the screenshot of RBI website. These are the present rates: policy repo rate, reverse repo rate, marginal standing facility, and bank rate. And just below it you can see reserve ratios are also there. Under reserve ratio you will see SLR and CRR will feature. Okay, before that we'll have few sample questions. According to the central government has notified in official gazette 4% consumer price index CPI inflation as a target for the period from August 5, 2016 to March 31st, 2021. Now, if you look at, yes, the inflation target between this tenure is 4%, but there is a margin, and the margin is plus minus 2%. That means this is the allowable margin. From 2% to 6% inflation is acceptable. If the inflation goes beyond that, RBI has to take necessary measures, necessary steps to make sure the inflation is under control. So answer for this question is option number 2, 4 plus minus 2%. 4 plus minus 2%. CPI is the method, consumer price index, through which inflation is measured in our country at present. Similarly, there is another term called WPI, wholesale price index. Earlier, India used to use this method, wholesale price index. Presently, we are using consumer price index. Again, a detail about this will be discussed in economics class. MPC is assigned with the task of releasing the monetary policy. What is the total number of members? So MPC, and who among the following is the chairman of MPC? Now, so in the options there is not showing what is the total number of members, but who is the chairman of monetary policy? Answer is Governor of RBI. Governor of RBI is the ex officio chairperson of monetary policy, and there are 6 members in monetary policy. You can see on the left side of your screen, Deputy Governor of RBI, then one Deputy Governor of RBI, one officer of Reserve Bank of India to be nominated by the Central Board, and there are 3 external members. At present, these are the 3 external members: Mr. Chetan Ghande from ISI, Professor Pamit Dua from Delhi School of Economics, and Dr. Dholakia, H. Dholakia, Professor of Indian Institute of Management, Ahmedabad. These three are the external members, and these three are members from RBI. The chairman is Governor of RBI. And the next question: which of the following is a policy rate as specified by RBI in monetary policy? Which of the following is a policy rate as specified by RBI in monetary policy? As we just saw that bank rate, the answer is bank rate. Base rate is related to lending. Base rate means the minimum rate of interest below which bank cannot give a loan. But remember, base rate is not applicable in case of all the types of loan. There are some special cases where the rule of base rate is not applicable. Let me give an example. A bank employee, when he or she takes a car loan, the rate of interest can be less than base rate. In case of agriculture, there are some special credits where the rate of interest can be less than base rate. So base rate is the general rule for most of the loans. This is the minimum rate of interest below which banks does not forward any loan, and it varies from bank to bank. It is not a policy rate, it is an internal matter of the bank. CD ratio stands for credit deposit ratio. Credit deposit ratio is the percentage of deposit what a bank goes on to give as a lending, as an advance. That means, let me give an example. Suppose a bank has got total 100 rupees as its deposit, both demand deposit and time deposit. Of that, it could give 60 rupees at loan, various terms of loans, and in that case 60% is the credit deposit ratio or CD ratio. Remember, a bank cannot give the entire amount whatever he has received as deposit as loan. There are some reasons why it cannot give. We'll understand in later slides. There are certain amount of money the bank has to keep it with RBI. There is certain amount of money the bank has to keep it with itself. Then there are NPA provisioning. It can actually lend only a part of that amount, which is known as CD ratio. CASA ratio, current account savings account ratio. CASA ratio stands for current account savings account ratio. It is the amount of money or amount of deposit in terms of demand deposit. As we know, there are two types of deposits, demand deposit and term deposit. It is the amount or portion of money lying in the bank in terms of CASA, current account savings account deposit. This is not a policy rate, you can easily understand, because it varies from bank to bank. CAR stands for capital adequacy ratio. It is the ratio of capital and asset. Again, we'll discuss this in detail when we'll be discussing Basel norms. Capital adequacy ratio stands for capital to asset ratio. For the time being, just understand this much. Capital adequacy ratio means capital by asset. This actually tells how safe, how secure is the bank, how likely the bank is to get bankrupted. So this is quite an important term, and obviously the answer for this question is bank rate. It is one of the policy rates. Which of the following is an option for a commercial bank in India to overcome its liquidity shortfall? Which of the following is an option for a commercial bank in India to overcome its liquidity shortfall? I hope you remember what is liquidity shortfall. When I don't have certain amount of money, but I can get it by tomorrow, day after tomorrow, so that if I borrow from somebody, I can give it back to them. In this question, if you look at LAF stands for Liquidity Adjustment Facility. LAF stands for Liquidity Adjustment Facility. It is a part of monetary policy. Under this facility, commercial banks can go to RBI and borrow money overnight or maybe for some 14 days to overcome its liquidity shortfall. That's why it is called liquidity adjustment facility. So clearly this is one of the option. Call money, yes, if a bank falls short of currency or liquidity, it can borrow from another bank overnight. This is known as call money. Notice money and term money, both we have discussed. This is up to 14 days, this is up to 1 year. So if a bank falls short of liquidity, it can take any of the 4 options. So answer is all of the above. Answer is all of the above. Now let's look at this various rates what we just discussed. Repo rate, and the most important one of the entire monetary policy, this has been the most important one and the most significant one. Repo rate, the fixed interest rate at which RBI provides overnight liquidity to banks against the collateral of government and other approved securities under the liquidity adjustment facility. I just discussed liquidity adjustment facility. So repo is a liquidity adjustment facility. Now what happens in repo rate? If the bank falls short of his liquidity, like Vishal, he fell short of liquidity and short term, he had to borrow something overnight. Next day he is going to pay. So the bank can go to RBI and go for or ask for an overnight borrowing. But in return, he has to give some, security. What he has acquired earlier, government securities. He has to give it as a, government security as a security, and then against it, he will take a loan. But then after that, after 2 days or 1 day, he will go and repurchase the agreement, repurchase the security from the RBI. That's why this repurchase agreement, this word comes, the short form is repo, repurchase operation or repurchase agreement, repo. So that's why it's called repo. Term repo is up to 14 days and 0.2% or 25% of NDTL. What it means, as I just said, under repo a bank can borrow overnight. But what if he has to borrow for a slightly higher term time period? Say 14 days, 7 days. Yes, they can do it. But there is a slab. They can borrow up to 0.25% of NDTL. NDTL stands for Net Demand and Time Liabilities. Net Demand and Time Liabilities. In other words, it is nothing but the total deposit with the bank. If you look at banks have got deposits in terms of demand deposit or time deposit. Demand deposits are money kept in the bank in savings account and current account, whereas term deposits are money kept in the bank in the form of fixed deposits or recurring deposits. So when we say NDTL, net demand and time liabilities, remember deposits are liabilities for bank. Let me repeat it. Deposits are liabilities for bank. That means bank has to give it back. They are liable to give it back. So when I say net demand and time liabilities, I am talking about total deposits with the bank. And under term repo, a bank can borrow 0.25% of NDTL. Okay. Reverse repo rate, the interest rate at which Reserve Bank absorbs liquidity. So look at the word reverse. It means this is the other way around. Now here, who actually takes the money? RBI takes the money. From what? From the banks. Now the banks are parking their extra money with RBI. So then why should a bank park the money with RBI? That is a question. Now also understand, if you recall one of the earlier slides, repo rate was 4.40% at present. That means if a bank takes a short-term loan from RBI, it has to pay 4.40% interest. Reverse repo rate is 3.75%. That means if a bank gives money to RBI, RBI will give the bank 3.75% interest. Whereas a bank, if it borrows to or if it lends to a customer like us, he will get an interest of 10%, 12%, 11%. Why should a bank simply go and park money with RBI? Generally, it does not do it. But yes, if RBI wants, RBI can increase the reverse repo rate and to suck in extra liquidity from the system. Tomorrow suddenly RBI says, okay, my reverse repo rate is 6%. So obviously banks would like to go and park the money with RBI, saying that okay, you take this money and give your security and I'll maybe exchange it later on. So this is an option. By using this, RBI can suck in extra liquidity from the system if RBI increases reverse repo rate. So let me summarize. In repo rate, commercial banks borrows money from RBI. In reverse repo rate, RBI takes money from commercial banks. Both are liquidity adjustment facility. Marginal standing facility, it is not a regular one. It was not earlier. After 2010, somewhere in 2011, it has been introduced by RBI. A facility under which scheduled commercial banks can borrow additional amount of overnight money from the RBI, dipping into their SLR, statutory liquidity ratio portfolio, up to a limit at a penal rate of interest. Now, there is some questions may arise. Why there is a need of marginal standing facility when you have a repo rate? Because both are overnight in nature. Whereas in repo rate, the rate of interest is 4.40%. In case of marginal standing facility, it is 4.65%. The difference is 0.25 percentage point. In fact, earlier the difference was 1 percentage point. That means when repo rate was 6.65% or 5%, marginal standing facility was 7.5%. So why there was a need of an extra facility? So we'll understand this. But to understand it, we have to understand what is SLR. Statutory liquidity ratio. It is the amount of money commercial banks need to keep them with themselves in terms of government security, gold or liquid cash. Let me repeat it. Suppose a bank has got a deposit of total 200 crores. Now it cannot keep the entire money to loan. It has to keep certain amount with it. Why will come? But it has to keep. Remember, it has to keep. Now say that amount is 19% for say or 20%. So out of 200 crores, if I consider 20%, it will come 40 crores. The 40 crores amount the bank has to keep it with itself. Right? Now how it can keep it? It can keep it in terms of government securities, it can keep it in terms of gold or liquid cash. Now what happens? When a bank takes the advantage of repo, when a bank goes to marginal standing facility. Remember, I took the figure as 20%. Now suppose a bank has government securities on and above that 20%. Usually banks have. On and above 20%. Now using that, and remember that 20% is of what? The 20% is of total NDTL, total deposit. Remember 200 crores was the total deposit. Out of that 200 crores, 40 crores bank has to keep it with itself. Now in terms of government security, let's say, but somehow the bank has got more than 40 crores worth of government security. Let's say it has some 42 crores worth of government security. Now when the bank falls short of liquidity by suppose 1 crore, he will use that extra buffer of 2% and go to the RBI and say, okay, give me this much of liquidity, 50 lakhs liquidity against that buffer. But now suppose that amount is exhausted. He doesn't have any buffer security. He has only 20% of the total deposit in terms of government security to make sure his SLR is maintained. Now what, even then also if he falls short of security, now what it can do, it can go to RBI or it can simply dip into its SLR up to a certain amount and use that cash as liquidity, use that amount or equivalent amount of the government security as liquidity. So this is under the discretion of the bank. Bank can dip into it, so it's called a penal rate of interest. That's why it says by dipping into SLR. So if it is 20% SLR, it can dip to 19% and use that 1% and convert it into equivalent liquidity and overcome its liquidity shortfall. And that's why, since the bank is not maintaining its SLR for a certain amount of time, that's why its rate of interest is slightly higher than repo rate. So MSF is under the discretion of bank whether it will go for it or not. Once the bank is not having the buffer amount of security, then instead of going for repo rate, it goes for marginal standing facility. In both the cases, commercial bank borrows money from RBI. How much a bank can borrow under MSF? This could be a current affairs question also. When it started, it was a 1% of NDTL. Time to time RBI changes it. It was at 2% recently. But recently what happened, in the view of the exceptional high volatility in the liquidity situation in the market in recent days, because of economic slowdown, COVID-19, RBI has decided to increase this amount from 2% to 3%. This will be valid till June 2020. So till June 2020, a commercial bank can borrow up to 3% of NDTL from the past 2%. Earlier it was 2%. It can borrow up to 3% under marginal standing facility. Bank rate, and the fourth one in the policy rate. It is the rate at which Reserve Bank is ready to buy or rediscount bill of exchange or other commercial papers. This rate has been aligned with MSF rate and therefore changes automatically as and when the MSF rate changes alongside policy rate and repo rate. So let me make it in a little bit simpler language. What happened? Look at the first two and look at the story of Vishal. Vishal had two situations. In the first case, it was a very small amount of liquidity shortfall. In the second case, it was a larger amount of liquidity shortfall. But when he went to buy the bike, when Vishal went to buy the bike, then it was not a liquidity shortfall. It is a different scenario altogether, and he was borrowing a larger amount and his repayment terms are also different. In this case also, when a commercial bank would like to borrow from RBI for larger amount and for longer duration, then they have to opt for bank rate. Earlier, bank rate and MSF were different. Bank rate were higher than marginal standing facility. But now these two are aligned, so as and when MSF changes, bank rate also changes. CRR and SLR. Now again let me put this two. CRR, the average daily balance that a bank is required to maintain with the Reserve Bank of as a percentage of NDTL. Remember this term, average daily balance. So is the CRR or SLR has to be maintained monthly, quarterly, yearly, half yearly or daily? Answer is daily. Average daily balance a bank has to maintain with RBI in terms of liquid cash. But in case of SLR, the bank will maintain a certain amount with itself in terms of cash or gold or government security. So there are three options in case of SLR. Now let's understand the concept of it. What is this reserve ratio and why there are two reserve ratios? I'm sure if you have seen the autos who run in some rural areas. Think of some autowala who run in some rural areas. You will see those autowalas will be also carrying some amount of petrol in some bottle which is put under his seat. Now remember, there is a reserve in the fuel tank also. Whenever we ride any bike, car, there is a reserve in the fuel tank. When the amount of fuel dips and it is close to certain last amount, so the indicator shows that your fuel is in reserve. So that reserve is for what purpose? The reserve is for so that whenever I am short of my resources, I come to know that I have only this much left. By the time I reach the next petrol pump, this will allow me to reach the next petrol pump. And for the autowala who is in the rural area, his petrol pumps are even farther away. So he is maintaining two layers of reserve. One is in the bottle and one is in the tank. Even the reserve in the tank is over in the extreme case scenario when he doesn't have anything else in the surroundings, so he will use his secondary reserve. Similar thing happens in banking scenario. In banking scenario also there are two layers of reserve. One reserve is protected with RBI. When the bank is disrupted, the bank is not about to pay its debts to its customers, then RBI will use that reserve to pay to the borrowers or to the people who kept the money with RBI. So this is a reserve which is protected with RBI and in terms of liquid cash. Whereas SLR is a reserve which is remaining with the bank itself. Now, how this figures changes? What are the range of this SLR and CRR if you look at in recent days and earlier? Now, if you see at present, the CRR and SLR are 3% and 18% respectively. The CRR and SLR are 3% and 18% respectively. But was it so all the time? See, it shows how this SLR changed since independence. In 1949, the SLR was something around 20%. See, it was written as a percentage of NDTL. And it gradually increased, reached something around 38.5% somewhere in 1991-92 when the economic reform took place, 38.5%. Then right after the economic reform, the LPG era, it has decreased steeply, again somewhere at around in the range of 20% and remained on the same range, 22-20% up to 2009. And then as the economy started further growing and there was a push towards the economy that India has to grow further, the banks has to give in more and more liberty and more resources so that it can give forward the same in the form of loan. It has decreased further and presently it is at 18%. So it is not that SLR is always in this range itself. So it started from somewhere 20%, moved to close to 40% and now it is at 18%. On the other side, if you look at CRR, it was at something 15% just in 1991, almost in the same period. So just imagine this is the time when the banks, you remember that cash deposit ratio, CD ratio? Now try to understand. Suppose total 100 rupees is deposited with the bank. Total 100 rupees is available with the bank in the form of deposit. Out of that, if 30, let's say 35 rupees is kept as in SLR, and 15 rupees, 35 rupees with the bank and 15 rupees is with RBI. So 50 rupees is not available for loan. So out of the total 100 rupees, only 50 rupees is available for the loan. So that policy clearly indicates that it is a credit squeeze. There is a very short amount of loan available in the market. Whereas right after 1991-92, you can see there is a steep decrease in both CRR and SLR, and the banks was having more and more resources, more and more money available with them to give it in the form of loan, which can further reflect in the economic growth of the country, that more and more loans were available, so people got extra fund and to spend, and the demands were created and the economic growth took place. So they are highly related with our entire economic changeover. Open market operation. This includes both outright purchase and sale of government securities for injection and absorption of durable liquidity respectively. Now there are two things. One is the regular process of government securities. That means the primary market and secondary market, where government time to time sells its government securities as per the pre-announced schedule. Whereas open market operation is slightly different. As and when RBI realized there is a need to bring some balance in the liquidity of the system, RBI conducts open market operation, wherein RBI can buy as well as sell government securities with some maybe extra discount or maybe some extra percentage of interest, something like that. Marginal stabilization scheme, market stabilization scheme, this instrument for monetary management was introduced in 2004. Surplus liquidity of a more enduring nature arising from large capital inflows is absorbed through sale of short dated government securities and treasury bills. This is slightly different. What is this more enduring nature arising from large capital inflows? Suppose an FDI took place, a large FDI took place in India, and or maybe number of FDIs at time took place in India. So there is a large amount of capital inflow in the market, which may lead to inflation. So what RBI does? RBI brings in this market stabilization scheme and absorb that currency. But then this is not kept in regular fund or regular account. There is a separate account called MSS account where RBI keeps this money. Okay. Let's quickly go through these questions. To enable better transmission of its monetary policy, the Reserve Bank of India, RBI, introduced LTRO in February 2020. What does R stands for in LTRO? Remittance, rate, repo, reverse, return. LTRO stands for long-term repo operation. Long-term repo operation. What is the difference with the normal repo operation? Normal repos are very short term, overnight and up to maximum 14 days. Whereas this LTRO are 1 year to 3 year terms, but at policy rate. Please understand. Earlier, if a bank has to take a loan from RBI, it has to pay under bank rate or MSF, which is generally more than repo rate. But in LTRO, if a bank opts for LTRO, he is getting a 1 year to 3 year tenure policy, but the rate of interest is only policy repo rate, so at lesser rate of interest. So how this is going to impact the market? Introducing this LTRO, RBI is actually ensuring that the benefit of the reduced repo rate is forwarded to the customers. Earlier, what used to happen? RBI reduced the repo rate, but the benefit was not forwarded to the customer because it used to take some time, the ripple effect, that it used to take some time to reach to the customers, and by that time another change was taking place. So even if, say, RBI reduced the repo rate 6 times, maybe a bank like State Bank of India is reducing their base rate only twice. Just understand. In the other side, RBI is reducing repo rate 6 times, so that the interest rate in the system goes cheaper and people can get more and more loans, more cheaper loans are available. Whereas bank like SBI or other premium banks are not changing the base rate that frequently as RBI is doing. So the benefit was not actually getting towards the customers. To introduce, to make sure that that takes place, RBI has brought this particular thing, LTRO, long-term repo operation. R stands for repo, option number 2 is the correct answer. Repo is the correct answer. Recently, RBI has brought back its bond swapping program, Operation Twist. Which among the following is true about Operation Twist? Bond swapping program. So there is some swapping takes place. Swapping of bond. Some bond is getting swapped with something else. It was practiced in December, January. It is also again practiced in recently April. So Operation Twist is not nothing new. It was practiced earlier also. Recently it is practiced in January, again in April. So it is an open market operation. Yes, it is true, where RBI buy and sell government shares. That's why it's called swapping. It is an open market operation. RBI will buy back long dated securities. That means those securities which RBI sold earlier but having long duration of some 6 years, 3 years, it will buy back those, and RBI will sell short dated securities. So RBI will absorb the long dated securities and sell the short dated securities. This is what is known as Operation Twist. So answer is all of the above is the correct answer. All of the above is the correct answer. The options are slightly jumbled over here. There are repetitive of 2, but don't confuse. The answer is all of the above. The Monetary Policy Committee MPC at its meeting on March 27, 2020 decided to reduce the policy repo rate under the liquidity adjustment facility by 0.75 percentage point to 4.40 percentage point from 5.15 percentage. 1 percentage point is equivalent to how much basis point? 1 percentage point is equivalent to how much basis point? When we talk about repo rate and reverse repo rate or marginal standing facility, like for example, presently repo rate is 4.40 percentage. It was earlier 5.15 percentage. So what is the change? 0.75 percentage point. The question is, it is equivalent to how much basis point? Because most of the time the reports of MPC are mentioned in terms of basis point. The answer is 1 percentage point is equivalent to 100 basis point. This is a previous year question. 100 basis point. In other words, 0.75 percentage point is 75 basis point. 75 basis points. What are the purpose of marginal cost of fund lending rate announced by RBI MCLR? I just discussed that even though RBI is changing the repo rate, the benefit is not forwarded to the customers, or at least it takes long time. So transmission of policy rate into lending rates of banks to improve, yes, that is one. Computation of interest rate by banks will get transparent, that is also correct. Like repo, MCLR is also decided by RBI. No, that is not correct. MCLR is a bank's internal calculation. RBI gave a formula, RBI gave guidelines based on which every bank every month has to calculate this MCLR, based on which it is going to set its base rate. Remember what was base rate? Base rate was the minimum rate of interest for which a bank will forward a loan. So what should be that interest? And it's vary from bank to bank. Now, what should be that rate of interest? That depends on MCLR. And how they calculate the MCLR? There's a guideline, there's a formula. There are some inputs. Those inputs are given, and using that formula, they calculate the MCLR. So answer is both 1 and 2. Both 1 and 2 is the correct answer. Both 1 and 2. Which of the following is a qualitative tool used by RBI to control the liquidity in the system? We talked about quantitative tool, repo rate, open market operation, marginal standings facility, reserve ratio. These are all quantitative tool. Rationing of credit is a qualitative tool. Rationing of credit, that means RBI will put some control, some limit that this much of credit one bank can forward, and this is the area where one bank can give the loan, or beyond certain limit a bank cannot give a loan. So this type of operation is called rationing of credits. So this is how it operates. Thank you. With the